Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. It's been an awful week for stocks, one of the worst this year. Considering the amount of effort the corporate media and wannabe gurus have put out to say that things were priced in, we now just in fact found out, for like the third time this year, that prices are not indeed priced in at all. And today we are going to examine various developments that not only will serve as further evidence about our bear thesis that the bottom has not yet been found, but that it may actually be a lot lower than initially thought. Beginning with real estate, I was shocked to find not a single corporate media make headlines that mortgage rates jumped back above 6%. As reported by Mortgage News Daily, it wasn't outside the realm of possibility to see lenders quoting conventional 30 years fixed mortgage rates in the high 4% range. A Freddie survey showed a modest increase of 0.11% from last week to 5.66%. However, on September 1st, mortgage rates jumped up to 6.23%, with the figures being derived from actually daily rate sheets as opposed to Freddie's survey's responses. Bonds sold aggressively in part to compulsory trading associated with the economic data that refuses to show any tightening impact from Fed policy changes. As monthly have gone by and the economy contracted, analysts are now expecting the U.S. to enter its first housing downturn, with Goldman Sachs saying the worst still awaits. Researchers released a paper forecasting that the activity in the U.S. housing market will end in 2022 across the board. They project sharp declines in new home sales, existing home sales and housing GDP. Furthermore, they are warning to not expect relief in 2023. Goldman Sachs is projecting further declines next year in new home sales with another 8% drop, existing home sales to drop another 14% and the housing GDP to drop another 9.2%. In other words, they are expecting the housing market recession to carry over to 2023. The Fed is hoping that the housing market downturn will slow down the rest of the economy and rein in runaway inflation. But what does this housing downturn mean for home prices exactly? Well, Goldman Sachs experts say home price growth is going to decelerate significantly, expecting home prices to rise just 1.8% in 2023. They do believe that the housing market will only begin bouncing up in 2024. But right now, there are more pressing fears that the economy could fall into a very serious recession that could last years and years on end, and at the moment, the housing market appears to be in full free fall mode. The supply of new homes is nearly as high as it was at its highest after the previous housing bubble popped, which is another leading indicator showing we are following in the same steps we did in 2008. Even further, after doing some research, the Homebuyer Affordability Fixed Mortgage Index has plunged to its lowest level since 1989 and 1 in 5 home sellers are being forced to drop their asking price. I have been telling you guys to follow the housing market close to chest while this whole economy fell, because we know that stocks do not in any way resemble any normalcy or balance. The housing economy, however, has served as a great tool to measure and even predict where we would go, and it should continue to do so for years in my opinion. I want to talk about this a bit again. We have discussed the phenomenon of trader psychology and the constant assumption that everything will end up in a bull rally. A large part of this was due to the onset of the pandemic, which saw a large increase of retail traders join the markets. There was a lot of money flowing around thanks to the Fed's irresponsible policy setting. The thing is, due to retail investor prevalence in the markets, typical market behavior has deviated from its normal patterns as retail investor psychology is vastly differently from institutional. However, as months of bear market sentiment weighed down over and over, bring and yielding negative results, we could see retail participation in markets decrease over time. I'm not saying it will go back to what it was, but it will certainly not be what it was 1 year ago. Also, keep in mind that this is all outside of meme stocks, which continue to remain strong. I am simply talking about retail's impact on the broad market overall is waning. To put some figures in your head, their trading made up around 18% of the overall volumes in the second quarter, which was down from the peak of 24% in the first quarter of 2021. Another leading indicator showing weakness of retail influence is trepidation surfacing, which shows stocks are falling fast in price action as fast as they soared over the summer. It will be really interesting watching how stocks behave in the coming months and years, but weakening retail participation could in fact actually help stocks return to normalcy faster than expected. This is no bullish sentiment though, don't get me wrong. We received news that employment levels finally exceed their pre-pandemic levels, with a gain of 315,000 in August payrolls. Now, I am about to clap general assumptions that this figure is bullish for the economy, because it is actually the opposite, so pay attention. A lot of people would assume that this rise in employment is good for the economy, and in theory and under normal circumstance, it would be. They aren't wrong about that. The problem is that things aren't normal, and people are greatly underestimating what the Fed's intentions are in this. Again, the Fed has made it clear time and again that they will fight inflation at whatever costs it takes, taking this fight to market companies and households. The problem with job numbers being good is that the Fed will take it as a sign that there is more room to increase rates. They see a good bouncing economy and all of a sudden they will see it as a sign for them to increase rates in the belief that we can simply take a larger hit. Powell has stressed that the Fed is not in a place to stop or pause their rate hikes, so the fact that unemployment was high is actually the biggest indicator that things are about to get much worse in coming weeks and months. Today we saw stocks begin to move up in the first half of the day as people ignorantly assumed these figures to be bullish for the economy, but Russia decided to increase pressure on the West and instead opted to cut off gas exports to Europe via Nord Stream indefinitely. This worsens the shortage that threatens to top the continent into an energy crisis this winter. As a result, stocks began to bottom once again and we saw earlier gains disappear. A new Bloomberg report shows that diesel demand belies recessionary worries. U.S. diesel supply hit a seasonal record in June. Bullish diesel demand coincided with increased drilling activity as soaring oil prices prompted explorers to deploy more rigs. The reason this is good is because trucking fuel consumption is closely tied to economic growth, and it's often a proxy for demand. But aside from that, everything I have seen this week has just been back-to-back bearish developments. Stocks suffered a third weekly loss with the S&P 500 contending with the longest weekly losing streak since mid-June. Unemployment remains relatively low as we said a minute ago, but the cause could actually be the minimal labor force participation rather than a booming economy. The Bank of America recently said that the S&P 500 index has not yet bottomed out despite its 7% plunge over these last 3 weeks. The bank's so-called bull market signposts suggest the board U.S. equities benchmark hasn't reached full capitulation and that stocks still don't look cheap enough for investors to start piling in. They actually said some of the same points I have been repeating for months in that the U.S. economy is still in early stages of a downturn. With no real signs of a bull market, Bank of America views the 17% rally off the June low as a bear market rally, and I full-heartedly agree. Given that our economy is so strained, German economy also tethering in the brink of a recession and India actually slipping past the United Kingdom to become the world's 6th biggest economy, I have absolutely no reason to believe or remain bullish for what lies ahead of us. I say this because even in the meme stock communities, I am seeing a lot of deluded minds say that we are due a huge rally soon enough. I have seen people mention Phase 6 and that AMC will go up above 20 and GME above 40 in a couple of weeks. I must ask again that you guys remain level-headed and in tune with the current market. GameStop and AMC are unlikely to have massive runs in the coming days and weeks if the market continues deteriorating as it is. As a result, I suggest you guys tune all these weird timely expectations and return to basic form, buy and hold. Personally, I've been holding off a bit from buying because I believe GameStop and AMC will be quite lower in a couple of weeks, and since I like buying in chunks, every dollar drop results in significantly higher amounts of shares purchased. With all that said, I hope you guys have an absolute amazing weekend. A lot of people have told me they are bored and are looking for other plays in the market to make money while waiting for MOAS. If you are a trader, or are looking to day trade, I highly suggest you guys come check out my Discord. We offer all kinds of day trading content and have a very large group of people there willing to help and teach you guys. We alert to stocks and when to buy and when to begin taking profits. We are very transparent with our performance and will let you see it for yourself and judge if it is right for you. We also have a robust AMC and GameStop community full of people like you who like to talk about the things happening every day. Come join us in the Discord. The link will be in this video description. There has never been a better time to join than now. I will be making another video either on Sunday or Monday. Remember that the stock market will be closed on Monday for Americans, but I will get out another video before the next trading session starts. Sorry for the inconsistency of released videos this week. I have been super busy in the Discord, but next week things should pan out a lot smoother, so I expect more consistent content being uploaded for you guys. I do post a lot of updates on Twitter and I am always in Discord, so if you guys have any questions or want to have a conversation about pretty much anything, Join me in either of these and I will get back to you as soon as possible. Let me know in the comments if you have anything fun planned for the weekend, and with that said, I hope to see you guys on the next one. Enjoy the rest of your day and to the moon.